keeping your portfolio balanced between growth and defense, right? Just, be careful overweighting your portfolio solely in the momentum chase. I know it's exciting and it's opportunistic right now, but again, a lot of these stocks they get very overbought. They're going to have pullbacks. You can buy them on these pullbacks, and again, use dips to your advantage. And then when they rally, learn to take profits and kind of rebalance that risk. And here's what you need to know before the bell, having said all that. On Friday, the market's kind of sold off a little bit. Nothing really surprising or shocking, kind of really in the moves on Friday. We are starting to see a little bit of deterioration in kind of the more technology-oriented, some of the momentum stocks. We saw a little bit of weakness there. That's not surprising at all. And, what we continue to see is just this market kind of grinding along the trend right now. So we're seeing a little bit of weakness in companies like Nvidia, a little bit of weakness in, companies like, some of the other kind of tech stocks as well. Again, they've had huge runs, so a little bit of rotation within the markets is fine. And one thing we kind of keep talking about is just, keeping your portfolio balanced between growth and defense, right? Just, be careful overweighting your portfolio solely in the momentum chase. I know it's exciting and it's opportunistic right now, but again, a lot of these stocks they get very overbought. They're going to have pullbacks. You can buy them on these pullbacks, and again, use dips to your advantage. And then when they rally, learn to take profits and kind of rebalance that risk. And again, that's all that's going on. But overall, as you look at the entire market, it continues just to trade in kind of this kind of very kind of sideways band over the last couple of weeks. We're not really breaking out to new highs at this point. And again, so when we start looking at the S&P in particular, we're just kind of holding here above the 20-day moving average. We still have this negative. The biggest concern I have right now is this negative divergence that we have right now with relative strength, where you have this trend of relative strength declining. You have this kind of negative trend in the momentum indicators as well. So again, momentum and relative strength continue to kind of negatively diverge from the markets. And as we've talked about before, that tends to show up prior to short-term corrections. And again, does not mean that the markets are about to fall by 20% at all. That's not what that means. But a 3 to 5% correction would not be surprising. A correction back to the 200-day moving average right now, which is this red line, would be about 8%. So again, that's kind of the maximum size of your potential pullback here at some point. But what triggers that, et cetera, who knows? Right now, people are just kind of ignoring all of the data and just kind of chasing markets in general. But again, this, we kind of go back and look, volatility remains extremely compressed here. We continue to just not see really kind of any risk at all. Even on Friday, when the markets are selling off, volatility remained very, very suppressed. So volatility transactions across the board, the bets on insuring portfolios against risk is really kind of non-existent right now as well. One thing that really jumped out to me over the weekend, we talked about how gold had been consolidating previously over the last few months. We said, hey, this is a potential here for a breakout. That breakout came of that consolidation. Gold is now as overbought as it's ever been. So, I mean, you're pushing really abnormal links of overbought conditions on multiple levels. Doesn't mean gold can't continue to rise here a little bit, but if you're long gold here, this is a great place. If you picked up on this trade, on this breakout, and add some positions, great place to take a little bit of profit and wait for a pullback. Historically, whenever you get these types of big relative strength overbought conditions, you're either going to get a pullback or a consolidation kind of within that asset. And again, that asset applies to, when you talk about just the technicals, it applies to every asset, whether it's, Nvidia or whether it's, stocks, bonds, whatever, the same thing occurs. When things get really, really overbought, you're going to get some type of a pullback or a correction. So just don't forget to take profits. But kind of the inverse of that is oil prices, which have really just continued to remain weak, but they've been basing here for a bit. So again, oil prices very oversold. The economic weakness is certainly being portrayed by what's happening in oil prices right now. But it would not be surprising if some event comes along, some type of geopolitical issue or whatever, something between Russia, Ukraine, whatever, that comes along that kind of gets oil on the move here a bit higher, just because it's really oversold here, really depressed, been under a lot of pressure. One of the things that we could also see here is just simply there's such a huge short position in oil. There's a lot of bets against the price of oil that you could see just a reversal rally in that. And if you see any type of reversal rally in oil, it's going to start to cause some of that short covering to occur. But one of the interesting things here is, despite the weakness in oil, energy stocks have actually been performing a lot better. And that's unusual. Usually there's a very, very high correlation between energy stocks and oil prices, but that hasn't been the case. Lastly, just real quick, we'll wrap up the market wrap here. Bond prices, yields fell fairly sharply over the last really kind of 3 trading sessions. We've kind of broken below a lot of the kind of the previous trends. We're in the trend in yields has clearly been lower now over the last several months. And that really kind of continues at this point. And again, as economic data continues to weaken, we're likely going to see lower yields kind of in the future. Now, that doesn't mean yields are going to zero by any stretch of the imagination, but somewhere mid-3s would not be surprising, particularly if the Fed starts to cut rates. One of the articles I've got coming up is that the Fed is really far behind what's happening in the economy. 2-year Treasury yields, which are a very high proxy for the Fed funds rate, is about 80 basis points lower than the Fed funds rate, and which says that the Fed's behind about 3 rate cuts right now. So the Fed may have to wind up playing catch up. That's not going to play well for either the stock market, but it will play well for the bond market. So that's what you need to know before the bell this morning.